do start our cameras and say hello.
Morning.
Hey, good morning. Good morning. Hey, James, how you
Yeah, I'm
doing? Good to
gonna
Morning.
see you
park.
again.
There's a reason why I'm parking right now.
Good morning. Good morning.
There we go.
Good morning.
Okay.
Very nice. Very nice.
Good
She said,
morning.
"Good morning." No, she says she looks ghetto. No camera for her.
Good
I look ghetto.
morning.
Hey, good morning. How you doing?
Great.
Good to see you, Faye. Good to see you, Erica. All right. Nice. Nice.
Good morning.
Good morning. That was Maureen. Hey, Maureen, how you doing?
I'm good. I'm good. How is
Awesome.
everybody doing?
Good morning.
Hey, Mion. Did I say that right? No, I didn't.
Mignon.
Mignon. All right. All right. Okay. The G has a NY to it. Okay.
Yeah, it throws everybody off.
You got me on that one. Good thing I didn't bet any money on it. And Miss Sandra Baptiste is here today. All right. All right, let's get started. Well, good morning, everyone. This is Saturday. Today is, our usual Saturdays with Eddie. And we are here to talk about options and everything about options. We don't have much on the table today, so this is going to be somewhere in between beginner type and advanced type. We're going to, kind of move in between that. What I had on my plate was to talk about moneyness. Anybody have an idea what moneyness is? See in the chat, anybody who can relate to moneyness. It is a word. No, nobody knows anything about that. Oh my goodness. All right, you all have heard of at the money or in the money. Yeah, there we go, Sabine. Sabine knows about the moneyness. That's what I'm talking about. That's what I'm talking about. So when we're talking about in the money, out the money, and in the money, then we're talking about moneyness. It's a word that I don't know that it will make it into the regular dictionary, but in the trading world, when we say when we talk about the moneyness of something, we are referring to, is it in the money or is it out of the money? And if it is, how far or how deep, stuff like that. So we're going to break it down and see how does that make a difference in our trading, especially with options, because that's all it applies to. And also, how can we use that to our advantage, right? This will be an opportunity for you to learn what that is. If you don't already know that, if you already know how to do that, then you will be able to make sense of it and even use it in a better way than you might have used it. Let me just do a quick sound check over here. Can everybody hear me just fine?
Yes.
Awesome. Very good. Very cool. Very cool. I'm also going to be sharing my screen. So let me go ahead and do that so that we can get started here. And I'm going to be sharing screen number 2 or desktop number 2, which has got my Thinkorswim. And hopefully that is what is showing for everybody. Is that just a couple people tell me what you're seeing on the screen?
Yes, we see it.
And what do you just you're seeing a chart
We
of
see your chart.
S
Yeah, chart.
SOXL? Oh, nice. Very cool. All right. Yep. Then we're in the right place, and I'm going to go ahead and go to the options chain. And I'm just going to pick an arbitrary number here. I'm going to pick 20 May, and hopefully you all can see that. You all can see that. So let's first do a room check. Anybody who does not understand in the money, because if everybody understands in the money and out of the money and all that, then we can move on to the next topic. But let's see, is there anyone who's confused about that? crickets. That means everybody understands that. Everybody understands in the money. All right. In that case, let's do a pop quiz. How about that? Anybody up for pop quiz? All right. We're looking at SOXL expiring on 20 May 2022, and let's assume we buy a 33 strike today, and then time passes and the strike closes at $40, and we don't sell it back. What happens? Let's see whether anybody can tell us what happens if we bought the 33 strike. May 20 comes around, we forgot all about our options contract that we bought at 33 strike, and the price closes at $40 on May the 20th. Give us a breakdown.
Was it a call or put?
It was a call. So it's a call option, 33 strike, and today is May the 20th. Price closes at $40. What is the status of my contract? So somebody says it expires, somebody says in the money. We may lose money if we do not close out the trade. So Bobby, tell us, how do we lose money if we don't close it out? So once again, the decision, I mean the scenario is you bought the 33 strike, and let me pull out my handy dandy pen here. So this is the strike that we are referring to. We bought it at, regardless of how much we bought it, it's the 33 strike. Current price is now $40, and today is May the 20th. It has expired. We did not sell it. So Angela says max loss. She's asking. Kay says it expires in the money. And Tanya is saying that it's something about shares. What about that? Closes automatically. Rita Williams, talk to me. Nobody's coming up with the answer that I want to hear. And Erica says that I've earned 700.
You would own it, right? They will put it in your account and you will own 100 shares, correct?
I don't know. Is that what they would do?
That's what happened to me one time.
Okay, all right. So there's some experience there. So the scenario again is you bought the 33 strike at whatever cost, and price closes at $40 on May the 20th. You did not sell it.
100 shares ended up in my account on that
And-
stock.
Okay, so you got assigned 100 shares. So you
Yes,
got
sir.
that was that in SIM or was that in live?
That was in my live account.
Oh, okay, interesting. All right. Okay. You lose all the premium. So Roxanne thinks that we lose all the premium. That is true. So we lose all the premium. Sabine thinks that it's a max loss. It is not a max loss. And Rita says that 40 minus 33 is equals to 7 times 100, which is 700. She's getting there. She's getting there. So the correct answer is, however much you bought it for, you lose that. Okay, at expiration, if you do not sell it, you lose however much you paid for it. So let's say you paid $11, right? You paid $11, or you paid $9, whatever. You say you paid $9 for it, and today is May the 20th, and the price closes at $40, and you're still holding it. So it expires. It expires in the money. It is not worthless. It expires in the money. And so the calculation for it actually does expire in the money, Erica. So the calculation here is that if it expires in the money, the contract still has value, and that value is calculated by the price at closing minus the strike. In which case, this is 40 minus 33, which would make it 7. And obviously, we multiply that by 100. So your contract that you bought that you did not sell is now worth $700. So what's going to happen is that $700 will be credited to your account. Right? $700 will be credited to your account because your contract expired in the money, it had value. There is no automatic assignment that I know of. Maybe some brokers will automatically assign you and sell you, buy that 100 shares for you. But to my knowledge, there is no automatic assignment. Let's build another scenario here. What if we change the scenario to where you bought the 46 strike? Today is still May the 20th, and the price closes at $40. What does that scenario look like?
I think it expires worthless and you lose the premium.
You lose the premium for
Yes,
however
and
much you paid. Okay,
yes, and it expires worthless.
it expires worthless. So that means that contract has no value.
It has no value because you're losing the premium and it's worthless. So always close, whether you're losing or not. Always close your contract before expiration date.
That I'm in agreement. I'm in total agreement with everything that he said. So if you bought the 46 contract, whenever you bought it, however much you bought it, and today is May the 20th, and the the contract has now expired. It's now 4:01 p.m. on 20th May. That contract has expired worthless. That is called expiring out of the money, OTM. Right? It has zero extrinsic value at that moment. It has zero intrinsic value at that moment. So no value, nothing, nada, zilch. Right? Let's do another example here. One last example here. Let's do an example where price closes at $40. This is the other potential that could happen, where price closes at $40 and you bought the 40 contract. Right? Hopefully that's a different enough color. But let's assume that you bought the 40 strike and today is May the 20th. It's 4:01 p.m. Contract has expired and you had the 40 contract. We don't know how much you bought it, but what is that scenario at this point now? You keep your premium, according to Erica. Okay, that's one answer. Any other answers? Okay. No other answers that I can see. You break even. Okay. All right, Peter. You break even. Maybe. I don't know. Anybody? Any other guesses? All right. The answer is you lose the premium that you paid. You do not break even. So break even, according to Sabine, is the stock price plus the premium, and that is correct. That's where we're going. So your break even point would be how much you paid. How much you paid for that particular contract plus the strike price. That would be your break even point. So for instance, if you paid $4 for the 40 strike, the price would have to be $44 in order for you to break even. If you bought the 40 strike and you bought it at $4 in premium, even if there was an unrealized gain of $1.90, which is $190, but you did not collect it because the only way to realize that profit is by selling that or closing that contract. But since you did not, you lose the $4 in premium. And if the price closes anything less than $44, you've pretty much lost everything. No break even for you. So to experience break even in that scenario, the price would have to be at $44 in order for you to experience a break even scenario. So what we've seen here is is there any advantage whatsoever to buying in the money, out of the money, at the money? Is there any advantage? And it looks like when you buy in the money, there's a resoundingly definite advantage to buying in the money. So if I add a few more columns, I'm going to remove all the paint here. I'm going to also add a few more columns to my layout, customize. I'm going to add two things here. I'm going to add intrinsic value, and I'm also going to add extrinsic value, right? And those two things do make a difference here. You notice that I'm going to scroll here. Can I scroll? No, I cannot. So you notice that everything that is in the money, which is what is shaded on my monitor, it shows a purple background. Let me highlight these for you. So this is that's the in the money, and this is in the money. So you're going to notice that everything that is in the money has got intrinsic value. Everything that is out of the money has got zero value. You see that? Let me change the colors over here to help you see that difference. You notice that all that is zero, all that is zero. So it's to your advantage again. Excuse me. It's to your advantage again to always buy at the money or in the money. Questions on that? Let's have some questions on that. And let me get a glass of water. Give me 1 second. All right, this is a quiet crowd. They know everything. All right. So anybody has a question on that concept of moneyness? So Angela is asking, when buying a call put, you buy in the money? Yes. Yep. Yep. So just to illustrate that question there for you, Angela, if you were considering, if this is SOXL and you were thinking that the price is going up, then yes, you would buy in the money. How far up in the money? As much as you can afford. But the rule here is, first and foremost, the strike needs to be less than the current price if you're buying a call, right? Rule number one, that's, obvious. Well, maybe not so obvious, but buying or choosing a strike that is less than the current price, first and foremost, guarantees that you're in the money already. Sounds good. Hope that answered your question there, Angela. Mary, do you have a question? Or was that Maureen?
Oh yeah, I have a question, Eddie.
Sure.
What are there any disadvantages for going deeper in the money, I guess, aside from cost?
No, you have all the advantage, and we can do a few examples just to illustrate that. For instance, if we chose to, let's assume that this stock is going upwards. The price is increasing from $39 going on to 40, 41, 42, and so on and so forth. It's rising, and you choose the 33 strike. You know what? Let me go ahead and increase this number of strikes to about 20, and let's see the difference. And let's assume that you get the 30 strike. Okay. Let's assume you get the 30 strike. That will set you back approximately how much? I'm still with you there, Mary.
It's kind of hard for me to see it, Eddie.
Okay. Let's fix that for you. Look and feel. Medium. I always forget about this. Okay, how about that?
A little better. Is
Okay.
that $12
It is.
and
And
yeah, okay,
5?
so
Yep.
okay, so $1,205, something like
1,205 is absolutely correct. So that's how much this would cost us. And at expiration, let us assume, again from our example here, that the price is going up as scheduled, or as our thesis states. For every $1 that the price goes up, you're earning $78, right? You're earning $78. But let's also consider somebody who bought the same stock, the SOXL, but they went with the 49 strike. This is all I can see. Maybe I should go with about 25 so that I can see the 50. Yep. So they went with the 50 strike, and they paid $2.50 because that's what's in their budget. Every time that the price of SOXL goes up, they only make $31. Right? They only make $31. But you instead, who bought the 30 strike, make $78. So if you both had a goal of reaching $100 or $200, who would get there faster?
me.
Yeah, obviously, the person who has a higher delta, you paid a little bit more, and you got your money a lot faster. Whereas the person who bought the 50 strike, you know, the underlying needs to move about. It needs to move. If we were trying to make $100, it would need to move about $3 or $4.
Okay.
And if this takes 4 days, well, let's think about that for a second. I am going to add one more thing here. I'm going to add theta. Excuse me. I'm going to add theta, and every day they will be losing about 4 cents of theta, right? So would you, but then your premium is increasing at a whole lot faster rate, so it is counteracting the effect of theta. But when you're out of the money, remember also that when you're out of the money, the entire value, the entire premium is composed of just extrinsic value, right? Extrinsic value. So only all the portion, 100% of the premium in out of the money is decaying at the rate of theta every day. Whereas when you bought in the money, your premium is composed of two things, both intrinsic and extrinsic value. It has got very little extrinsic value, and it has got more intrinsic value. Intrinsic value does not decay. And that's a key difference. Intrinsic value does not decay from theta. Extrinsic value is the one that decays. So that was an awesome question there. Okay.
Okay, thanks.
Rita wants to know that if you earn $78 when the stock goes up $1, do you have to wait until 20 May to close the contract? No. You can close it 1 minute after it has gone up $1, or as soon as it goes up $1. Can you get out when you make 100 goal, even if it is earlier than? Yes, you can. So that is a misconception again that people misunderstand. They think that because they bought 45 or 60 days to 90 days out, that they have to wait that long. That is incorrect. In fact, you do not have to wait. You can actually be in an options trade for less than 1 minute and achieve an astronomical amount of money. My experience, I have been in a trade, the shortest time I have been in a trade is 6 seconds. Right, 6 seconds exactly. I haven't broken that record yet, but I have been in a trade for 6 seconds, and you've made $500 in 6. I thought it was a mistake. And this was in live, not in sim. Right? Happens all the time. So I've seen a lot of times that you can be in a trade, especially with a bracket order where you get in, get out, usually under a minute. And that's very common. So no, you do not have to wait until May the 20th. Let's look and see what kind of questions are coming in. Booming wants me to explain assignment again. So assignment, I actually haven't not talked about assignment, but let's talk about assignment. Let me first also clean up my view here. When does assignment happen? So assignment happens on a short call, right? Usually happens on a short call or a short leg. So this is when you are doing credit spreads. That's most likely when it happens. In a credit spread situation, you bought one and sold one. And the one that is at risk in such a situation is always the short one, because you gave up the right. You gave up the right to, or you give somebody the right to buy from you at a particular price. And so you're obligated. You are obligated to honor that contract. On the other hand, when you go long, when you buy, you have the right, but not the obligation. So assignment is almost impossible. I don't know how somebody was who was saying that they were assigned automatically. Not sure how that happened, but it is very unlikely for you to be assigned stock when you are long on a particular trade. It's when you are short on a trade that you're likely to get assigned at expiration or even before that. So what's that situation of assignment? Assignment, like we said, you give up that obligation, and the party that you sold to exercises their right to buy from you at a particular price. The only reason they would want to do that is if the price is advantageous to them, and that's why they bought it. So in a credit situation, a credit spread situation, that scenario would be very, very favorable to the opposing party if your spread is now in the money. Remember, in a credit spread, you really don't want your spread to go in the money. And this is now an advanced topic, but we can cover that as well. You do not want your spread to get in the money. You want it as far away from the money as possible, right? Which is opposite from a few other spreads, but that is why that is what can happen with assignment. In fact, just because of that risk of assignment, that is why most people will do credit spreads on the indices. They will do credit spreads on the NASDAQ, the Russell 2000, the Dow indices, but they will not do credit spreads on regular equities like Amazon, Apple, Tesla, Shop, and so on and so forth. So if you want to remove that risk of assignment, then you can do you can do what? You can do spreads on indices, or you can do any other type of spreads like debit spreads or condos on anything else. Any disadvantages of getting out of the options contract earlier? No, there are no disadvantages. You have all the advantages. It's called taking your profit off the table. That's what it is, Rita. Okay. Very cool. All right. Well, let's also consider about spreads and moneyness, right? Because we just talked about straight calls and straight puts. When is a spread considered in the money or out of the money? So for that, I am actually going to switch my spread from type single to type vertical. And notice now that I have pairs. I don't actually like these pairs. I'm going to select one of my favorites. I don't think you guys have even ever heard of this stock. Anybody ever heard of this stock? Yeah, it's a new one. Yeah, this is a new stock. Just came out the other day, right off the press. You guys haven't heard about it, but on Monday, look for it. Yeah, Angela never heard about it. So let's consider that you are looking at the chart here for SPX. Let's see what we're having here. I drew some things. Let me clear my drawing set. Yes, I do. And the current price is 44.6312. Okay. And today's class, by the way, is only going to go about an hour, 15 minutes maybe. So get your questions in. Current price. Yeah, I'm going to show these on the left and push that. So assume that I want to entertain the idea of a put credit spread. When's a put credit spread when can we do a put credit spread, by the way? When we think the price is going up. And do we think the price is going up for SPX? Or is it going to go down? We don't know. Is it sell the put? Okay, sell the put. Do I think SPX will fall below 4,000? I have no idea, but it's very unlikely. It's very unlikely. So if I were to consider selling a put, I would consider selling a put somewhere outside of the next buy zone, or rather support. So this appears to be my support right here, which is 41.61. That is pretty far. But I would also consider what the expected, what the ATR is, which is 94. So let's do some math here and consider that 44.63 less 94. So 43.69 is where I want to consider. 43.69. You know what? I like to round up. So 43.70 is it. So I'm going to consider selling, put a credit spread somewhere below 43.70. There's a lot of math that went into deciding why 43.70. That was based on a couple of things, ATR of 94, as well as the expected movement, or the IV of this trade, which is at current 43 or plus or minus 43. So I think that 95 is a fair value. So I'm looking for a spread below 43. And I lost my train of thought. 43.70. So 43.70 is 43.70 is somewhere here. And because this is right at the money. 43. Did I say that right? Let me do that math one more time. 4463 minus 95 is 43.68. And that should be out of the money.
I think you were on 4-4.
Am I on 4-4? I'm trying to subtract 44.63. I'm trying to subtract 95 from 44.63.
Yeah, go back to your trade.
Go back to my
Yeah.
trade.
Go back
You
to
were
your.
on 4-4.
You were on 4-4.
Okay, and I need to be at 43.
Yeah, you need to add
Three.
more strikes.
Ah, yes. Thank you so much. Is today Saturday by any chance? There we go. 43.70, right? Yeah. So 43.70. Do we have any premium there? No, we do not. Well, looks like that. We have 40 cents. I think we have 40 cents. So this is where I would be trying to sell a put credit spread at 40 cents. Kind of low at this point. Will it get any better? I don't know. But 40 cents is somewhat on the lower side. Would it be prudent for me to go even closer than this? It's possible. It's possible because I'm still pretty far from the money. And by the way, the money is anything that is shaded in this color. So normally when I'm selling or considering selling a put credit spread or a call credit spread, I would go at least 6 deep out of the money, right? 6 out of the money. So 1, 2, 3, 4, 5, and 6. That means a 44.30, 44.35 is considerable. I might even go up a little bit higher to the 44.30. So let's consider where the 44.30 sits on my chart. 44.30 is right about there. I'd have to be really crazy to want to do that. That would be, yeah, I'd have to be, well, maybe not even crazy. I think I'd have to be nuts to consider that. Bad idea. So a better idea, I think, is to look at the implied volatility and go with the 45. This seems like it's a much better deal. So let's go with the 45, 44.63 minus 45. So 44.20, I'm looking for anything below 44.20. And this is where we land. So this would be the better deal. Okay, let's talk about that for a second. Why did we choose that? What was the argument for that? When deciding where to place your strikes on a credit spread, there are a couple of things that can guide you on that. Number one is the ATR. ATR says that we can move plus or minus $94. Implied volatility tells us that we can also move plus or minus $43 in this particular case for the 21 March expiration. This will change by Monday. But right now, we think that about $45 movement plus or minus is where we are landing on. So this, any number between 45 and 95, you need to be that many points away from the current price to place your spread. Does that mean that because we're calculating it right now, we can go ahead and set this order up for execution on Monday morning? And says no, because on Monday morning, a lot of things will have changed. Some of the things that will have changed are what's happening in the futures. The futures are characterized by the symbol ES. Right now, we are trading the M22. We just switched over from the U, rolled over to the M22. That's a futures thing. Topic for a different class, but we're checking to see what that movement is on Monday morning to see what direction we're going. We're checking other things that you normally would, like CNBC or whatever method that you use to determine the momentum or the direction, and then whatever current price the market opens at or S&P opens, that's the point at which you calculate, not before the market opens. So that's the distinction. That is the distinction. So assuming that the market is open, that is why I would go with a scenario like the 44.20 right now trading at 95. You might see this price Monday morning, but if you don't get it right quick in the morning, that starts to decay super fast. And I forgot what was the question for that. So I was trying to explain going out of the money. So for a credit spread, you want to sell out of the money. If you're buying debit spreads, you also want to buy out of the money. But there's two different outcomes that you want to consider. When you sell a credit spread, whether it's a put credit spread or a call credit spread out of the money, the best case scenario is for it to expire out of the money, right? That's the best case scenario. And thank you, by the way, for the cash up. Awesome. And when you're buying a debit spread, you buy it out of the money, and the best case scenario, now listen to this, best case scenario is for it to expire in the money, right? Gonna let that sink in there for a second. In the money, when you're doing a debit spread, anytime that you're going long and you're paying a debit, then you want it to expire in the money. If you're selling and you're receiving premium, best case scenario is for it to expire out of the money. That way you keep 100%. 100%. James is asking negative delta. What do you mean negative delta? Negative delta. Do we care about the delta in this particular case? No, we do not. We do not. That's the other distinction here. When we're talking about singles, right? When we're talking about single calls and single puts, we care about delta. When we're doing spreads, not so much. There are some people who trade based on delta, in which case they would actually go into, I forgot to remove the intrinsic here. Remove item. They actually go into the spread single and look at the delta to see the probability of in the money and out of the money. So remember that delta has got two functions. One is to tell us how much the premium is going to increase for every $1 increase. That's function number one. And then function number two for delta is to tell us the probability of ending in the money. And I think that's where James Adams is leading to. So with a 44.20 strike, we have a 25% chance of this particular contract expiring in the money. Whereas with I'm just going to go with a 44.90, then we have a 69% chance of expiring in the money, right? I think I said that backwards. Because I was looking at the puts side. I should be looking at the calls side. With at the 4,500 strike, we have a 26% chance of expiring in the money, right? There's less chance of this going all the way to 4,500 according to these metrics that we're looking at. We are at 50-50 right at 44.63. At the 44.60 strike, we are right around 50-50. Do you see that? Half and half. We don't know, right? But the deeper you get into the money on a call, going to the 4,400, we're up to 81%. Does it go all the way to 100%? Yes, it does. It should go all the way. If I increase this enough points, it should go to 100% chance of ending in the money. So the person who was asking about, do I think SPX will fall below 4,000? Resoundingly, no. I don't think so, right? Just by looking at these, the likelihood of that ending at 4,000 is non-existent. 4,300 is already 90% or 93% assured that it is going to be in the money. So, Haiti, that was for you, that question. All right, can I show how to choose a debit debit spread strike, or is it just the opposite of a credit spread? It's not just the opposite, and it goes right. There's more detail into that. That is one of the things that I teach, by the way, debit spreads and short butterflies and stuff like that. So please contact me, and I will be able to show you options with Eddie. Brittany, if you don't mind dropping that link there for me. So, okay, what other questions do we have there? Cheryl, do you have a question? Cheryl does not have a question. Okay. I see Kali and Ololade also unmuted them. Incidentally, if you have a question, just go ahead and raise your hand, and then we'll just follow that order. All right. Let's see whether I can say it correctly this time. Ololade.
Yes.
Hey, did I say it
Hi,
well?
Eddie. Yeah, you did a good job.
Awesome.
You're not there yet, but it's okay, Eddie. It's okay. Eddie, I
Maybe
have a
next week.
question about the ask prices. Like, how do you negotiate a good price to get into the trade?
So you're talking about you're
Right.
trying to get into a call or a put, and
Yes.
and you want, okay. So that's very easy. You tell them how much you want.
And it will always come to you?
No, not really. Within reason. Let me elaborate.
Okay.
So consider that I'm looking at the spread single and SPX is say increasing, right? From 44.63 it's going up towards 4,500, for instance. And I have decided that I am going to buy a call at the money at the 44.60. Okay. Notice the bid and the ask columns. Somewhere in between, this is what the price, this is the fair market value, I want to say.
Okay.
I can immediately buy it at 26.20, but I can also put in a bid. I can also put in a price of 25.60 and hope that the price is going to come back down a little bit such that I get picked up or get filled at 25.60. So when I say that I tell it how much I want to buy it for, usually it is within that range. It's not just an arbitrary number. So the mid price is actually calculated as the mean or the average between the average of the bid and the ask prices. So if you pull out your calculator and the 25.60 plus 26.20
Right.
and the sum of that you divide it by 2, then your mid ought to be 25.90. So I can put in a bid of 25.90, completely ignore what Think or Swim says here and say that I want to pay 25.90, and I believe I can get filled on that almost immediately.
Okay. Okay.
Almost
That really
immediately.
helps.
So you can negotiate that price. Now here's another cool thing, by the way. If you're using Think or Swim, you can adjust this price here up or down. And if you're looking at my screen, notice the expected SPX price, right?
See that.
Expected.
Right.
So I'm just going to reduce this 25.90 and notice what's happening to the expected price. Do you see that?
Yeah, it's
It's
going
reducing.
lower.
It's
Yeah.
going lower. So if I bid 24.80, I am saying that I am expecting that the price is going to go down to around 44.60, which is about $3 less from where I am. So if I'm looking at the chart and say I go into the 15-minute time frame, which is about the lowest that I ever go, hint, hint, then it is reasonable for me to expect that this price can fluctuate between 63 and 60. Do you see that?
Yes, I do.
So why pay more than I need to? If my thesis is that the price is going to increase, then there is really no reason for me to pay the MSRP. Are you familiar with MSRP? That's an American term.
No, I'm not.
It's the manufacturer's suggested retail price. How do I know that? I don't know. One of those random things you learn in Jeopardy.
Buying cars.
Buying cars and expensive furniture and all that, right?
Yeah.
Yeah. So maybe I watch Jeopardy too much. I don't know. I should probably I don't know, something. But yeah, don't pay full price for what are they, contracts. You no need to pay full price. So that would be an example of how you can negotiate a lower price. Are you negotiating? I don't know. You're just telling the market that I know that this price is available in the market because this price is can go as low as 44.60. So that's how you would be able to get in on a good trade. Again, you would need a good thesis that this price is continuing to increase. You're also taking advantage of the fact that, there is this fluctuation happening. Let me zoom in a little bit over here. Do you notice that we have a wick down here?
Yes, I do.
All right. So the lowest point that I'm seeing on this wick is the 44.55. So the prices in between here are available to me. I know that for a fact because this wick was at one time solid green or solid red, whatever the case may be. Right? So all those prices, if my continued thesis is that the price is going to go up, then I can bid. Whether the price is going to go up from this point, I don't know, but I know that I can probably get at that.
Thank you so much, Eddie.
You're welcome. And if you pick it up at 44.60 and even get out at the current price, then you've already made some money on that. Good question. Hey, Maureen, what's up?
I wanted to see if you could go back over why you want to be out of the money for debit spreads or start out of the money.
Okay. In a debit spread situation, and I'm going to go here from spread single to spread vertical. In a debit spread situation, your thesis is that price is, well, a debit spread, first and foremost, that's a directional trade. We understand that, yes? So we know that when price is going up, you can consider getting into a call debit spread, or if price is going down, you can consider a put debit spread. So because it is a directional trade and you're paying a debit, then your thesis is that since we know that when price is moving towards a spread, whatever kind of spread it is, when price is moving towards a spread, the value of that spread increases. We all understand that?
Yes.
I know, yeah, most of you, I know, trade credit spreads, so you know that the value increases up to its maximum value, which is usually the width of the spread. So it's to your advantage, since in a debit spread you're buying low, selling high, which is the opposite, by the way, of a credit spread, where you sell high and buy low. In a debit spread, you're buying low, selling high. And so you want to buy it out of the money. That is the only way that you can buy it low. Yeah. Let's take an example here. If we think that the price of this particular stock that you guys have never heard about, which is SPX, is going to go to 4,500, this is just an example, then we could potentially pick something closer to that, and we were going to click on the ask column. Notice it says buy, and as the price moves towards 4,480 or 4,500, this should increase in value. So does that help?
Yes.
All right.
Perfect. Thank you.
You're welcome.
Justine has a question in the chat for you.
Justine, why is the bid price negative sometimes, and what does it mean if you buy at a negative price? You cannot buy at a negative price. You cannot buy at a negative price, but she wants to know, why is the bid price negative sometimes? All right, that situation does exist. Let's look for a situation where the bid price is negative. I'm going to go to one of my other favorites, like Amazon. I know that this one has got negative prices sometimes. No. Maybe if I go here, nope. Let's go 62 days. Okay. Let's increase this from 14 to, I don't know, 50. First I do need to get into the vertical. How about that? There we go. All right. So her question is, why do I see negative prices on the bid sometimes, right? Both out of the money and in the money. Why do I see that? What does it mean? Can you actually buy these or sell these for $1.12 credit? Will somebody do that for you? No. So what's the reasoning? Why is it that these numbers are negative? If you want to buy a debit spread, obviously you're going to be clicking on the ask price, but notice that this 29.90.95, that's a 5-point wide spread. From what we know about spreads is that the maximum value of a spread is the width of the spread. And how much is this one wide? This one is 5-point wide. We get that by simply subtracting 29.90 from 29.95, or the other way around, just counting on your fingers, and something like that. So its maximum value is 5, but we notice that the expressed value or the indicated value here is 815, from minus 590 to 815. So let's explain that. When you are buying a spread or selling a spread, there are two transactions involved. One of them is buying, the other one is selling. So you're telling the system, you know what, go find me, when I click on 815 for this particular spread and I want to pay $1.13 on that, I'm telling the system, go buy me one contract, right, at the 29.95 strike, and also go find me somebody who's who's willing to buy the 29.90 from me. That's what you're telling the system. And because the way it works with the debit spread, the selling part is always going to be less, right? It's always going to be less in a debit spread situation. The leg that you sell is going to be cheaper than the leg you buy. That's how you end up spending more money than on a credit spread. So in the market, that is, we understand now that it's whatever price that is in the market. I don't know what the price is of the 29.90, but I can find out what that price is, and I'll show you. I'm going to switch from let's see, that was the 29.90, 29.95. Let me write that down so that I can demonstrate that. 29.90, 29.95. Justine is testing my academic information here, so we're going to try and live up to this. I'm going to change this to single, and let's do it the manual way. Let's do this the manual way. We said here in that spread that we are going to buy the 29.95. Is that right? Go back here to vertical, 29.90.95. Yep, we're going to buy the 29.95, and we're going to sell the 29.90. Okay, let's go back. I don't know whether we need to actually learn this particular part of the academic part of the equation here, but in this scenario, we are selling the 29.90, so I will be selling these at $85.85. First, delete that. I'm going to be selling these at $85.85. That's how much it's going to. That's how much I can net for it. At the same time, I am going to be buying the 29.95, which costs $94. What's the difference between these two? 94 and 85.85. So I'm going to pull out my calculator here. 94 minus 85.85. That is $8.15. That is the widest point. You see that? So to do this manually, I'm going to push the control key on my keyboard. I am going to click on buy, and notice I come down with the same thing. So the high end of my spread is $8.15. In the market, that's as high as I can get for the 29.95. There's a big range. So that's how we explain that you've got a lower range and you've got a higher range, but the system will calculate it for you and give you the best price or the mid price. And also notice that my mid range here is $1.13 and my highest price is $8.15. I don't know whether you can follow my mouse. So Justine, do you see how we come up with or how we explain those negative values? You've got a really wide range. So good question there, Justine.
Yeah, you hear me?
Yep, I hear you.
I was asking because earlier this week I did a debit spread, and I think I accidentally did my short leg with a negative value, but it made me more money. So I'm trying to figure out, like, what did I do when I bought it at a negative price?
Okay, so you probably got a credit to begin with, and then you sold, and then you bought it back.
Oh, okay.
Yeah, we'd have to look at that particular scenario to see what actually happened.
No, you have.
Yeah.
I don't like that one. I want something like that.
All right. All right. Good deal. Hope that answers your question there, Justine.
Yeah, we'll look at it again when we meet this week, hopefully. So
Yes. Yep. For sure.
All right, let's see who else has a question up there. I see a question in the chat. What do the letters mean next to the bid or ask price for either, for example, AH? She's asking about these letters. What do this mean? Okay, that's an easy question. These letters represent where this price came from, right? IJXIDIMJ. Those are the numbers that she's asking about. They are also on the ask. So where did these prices come from? What do they mean? You notice that when we set up our order, we have the choice, we have the chance here to select what exchange fills this order. Most people don't even mess with it. They just stay with the best. But you could potentially go with the CBOE or the Philadelphia exchange or the ISE, whatever exchange. And so these exchanges do have codes. Actually, it's more represented when I go to the spread single. Yes, spread single here. I might have more choices. There we go. So I can choose the best. I can let the system decide for me where do I want this price to be filled in, or where do I want this contract to be written. And most people don't care. I don't care usually, right? You can fill it at the Amex, you can fill it at the box, New York Stock Exchange, NASDAQ. I don't care. Just give me the best one. That's what these numbers mean. Cool. Good question. You are welcome.
Eddie, I have a question about that.
Sure.
Yeah, is that the reason why you could be filled, and if you're watching the price movement on the options chain, you may not necessarily see the I guess the price or the premium that you requested, but you get filled anyway? I know you said something about that's in the past, but
Yeah, so when you're having difficulty getting filled, and I've seen that situation where I had to go in and actually choose the exchange where I knew that I want to get filled, right? I mean, or no. Let's say that again. Where I had a good feeling that there was enough liquidity in that exchange. The CBOE is one of the strongest. So I was working with SPY at the time, and I know SPY and SPX are products of the CBOE. So if I ever choose to be filled just from the CBOE, I know that I can get filled like, A1 quickly, right? But normally, since those products can be traded on any of those other exchanges, I really don't care where they get filled. I usually just go with the best. But those are extreme situations. The other situation where you might care about what exchange that your order is going to get filled at is if you buy an OTC stock, over-the-counter stock, right? Some stocks are not very actively traded on all the exchanges, so you may consider that they're not on the mainstream exchanges like the NASDAQ or the NYSE, and so you might be required to actually go in and select that particular exchange. Would I recommend that? If you know what you're doing, yes, you can do it. If you don't know what you're doing, or you don't care about that exchange, then simply leave it at best. On other platforms, it might actually say something like intelligent. Like if you're on TradeStation, you might see it saying intelligent, or best route if you're on Robinhood. But for most ordinary retail traders, it really doesn't matter. Now, if you were doing futures, right? Say you're trading the YM or you're trading the ES, then it might make a difference about where that actually goes. So, but we don't talk futures in this class. We can always talk futures in a separate scenario. Good question on that. All right, let me try and read what Adam is saying here. Adam wrote me a long letter. If you buy either a call or a put, you're going long. and your strike should be in the money. Correct? Yes. And just the opposite, when selling call or put, your strike should be out the money. When you're selling, the strike should be out the money, and you want it to expire out of the money. That is correct again. I have to think about that for a second. So James is presenting a complex situation here where he's selling a regular calls and puts. I'm sorry, he's buying regular calls and puts, and he wants to buy them in the money. That is the preferred way to do it. That's the normal way to do it. And then he's also describing a situation where you are selling a call or selling a put. I'm assuming here that he's selling naked. Is that about right, James? Are you selling naked? Then your strike should be out in the money and no verticals. All right, so you are selling naked. When you're selling a call or selling a put, it means that you're opening a short position. No? No to what? Let's unmute you, Mike. James. James. But a vertical. Okay, so you're referring to a vertical. Right? If you're inside a vertical, then no, it is not naked. But you're still correct. You're still correct in the sense that when you're selling, that situation should be out of the money, and you do want to expire out of the money. So, all right, cool. Udo, I can show you that on a private session, on a consultation session. I can definitely show you that. So, awesome. And I'm also getting a direct message here for. Why is today's session free? The reason last couple of weeks ago I said that I was going to charge for this session, and then after thinking about it very, very carefully, I decided, you know what? I don't know whether I can give this a value. I don't know how much value I can give it. So I was not able to come up with a figure. And instead, what I decided is that I'm going to make it absolutely free for everyone and anyone in public. And instead, I'm going to let you decide how much it's worth to you, or not necessarily how much it's worth, but how much you want to appreciate it. So if you want to appreciate it, then you're welcome to do that, and let me know, and I will put in a Cash App handle that for that. And that's simply just my name, first and last name with a $sign in there. So thank you. Received quite a few today. Thank you very, very much. All right. All right. Let's see. Any other questions that I'm missing out there? We're coming up at 12:09. Any questions?
You had one in the chat where she's asked or said you were going to go over what you considered an A+ trade. Will you be willing to go over that?
An A+ trade. Okay. Yeah, we can do that. So an A+ trade is really, really, really simple. This is going to take me like 30 seconds, maybe 29 seconds. It's the one that makes you money. No, not really. So an A+ trade is one that has a very, very high probability of success. So let's talk about that. And that was asked by Erica. Erica, what do you trade most of the time? Let's go with that. What kind of stocks? And it's okay to unmute yourself. Give me an example.
So literally, I'm still just learning, so that's why but like Amazon and Facebook, I'm just playing in my sim.
Okay. And so you mentioned Amazon. That's fine. And are you trading options at all at this point? No? Okay.
Yeah, but no.
Not yet. Okay. So that's cool even
But
when
I
you...
have a really good understanding. I'm I have a really good understanding of how to trade options.
Got it. All right. So your question really is, what is an A plus trade? An A plus trade is one that an A plus trade is one where I want to describe it from start to finish. This is good for everyone, whether you're trading stocks or whether you're trading options. What is an A plus trade in my book? So in my book, what I consider an A plus trade is, first and foremost, I have a trading plan that says I'm expecting to make X amount of dollars for every trade. I have a minimum amount of money that I want to make on every trade. That is in my plan. You need to write it down. You need to define that. But you don't just write an arbitrary number. You have to come up with a plan that tells you exactly how do you come up with such a number. So let's imagine, for instance, here that you have decided that on every trade you are going to make $500, right? And you decide that that's what's in your plan. $500 is how much you want to make on every trade, minimum, okay? So once you figure out how to make 500, by the way, Erica, do you know how to make any goal? I'm going to put you on the spot here for a second and work with me. Do you have a minimum amount of, or a target that you're working on?
Literally $500 was it. Yes.
Okay, so $500, is that per trade, or is that per week? Is that per day? Or what is that?
Oh, per trade.
Per trade. Okay, I like that. I like that. $500 per trade. And we're trying to figure out what that is. So once you figure out how to make $500 on a trade, not every trade, but a trade, then that becomes your benchmark and you decide, I'm going to execute this. If it means that the price movement needs to be about $20, and I think that's about right. When you're trading options, you need a movement around of somewhere between $10 and $20 in order for you to make $500 if you're trading one contract, right? And you decide that I am going to trade only stocks that move a particular amount of points or money. If you're trying to make $500, that needs to be about $10 if you're buying at the money. You with me on that?
Yes.
All right. How did I come up with $10?
10. I don't know.
Okay. Well, let's think about delta. If delta is 50, right, and the price moves $10, that's $500, right?
Oh, that's 5. Yes.
Yeah. So an A plus trade, we're trying to build that. We've decided $500 is the minimum that we want to make. So it must move at least $10, and we're always going to buy at the money. So she trades Amazon. I'm going to go to 45 to 90 days, which is again the 20th of May. Let me reduce that so that I can see just at the money. She says that she's going to spend about $19,775, which is roughly at the money at this particular moment in time. And if Amazon only moved $10, she would make $500. I guarantee you that if she bought this trade Monday morning, she can make that. I shouldn't use the word guarantee. That's bad. Edit. Right? No, but there's a really good chance that if you are on Amazon and you buy it at the money, then there's a good chance that Amazon can move $10. What's the ATR on Amazon? It's 118. Looking at the chart for Amazon, this bad boy moves quite a bit. Moves $50, $20 at a time. So she can get $500 really easily, but she would have to spend $19,775. Is that a good use of money to make 500? I don't know. I think I'd want a little bit better return on investment if I was going to spend almost $20,000. I might as well wait for it the whole day and make that $10,000. Is it possible? Yes, it is on Amazon. So as you work your way towards finding a good stock, find one that is within your reach, meaning that you can afford it at least 45 to 90 days. It moves at least $10, and there's more to that, by the way. There's a whole trading plan that I can go over with you in my class that will teach you step by step, including how to calculate what that is. But I'm giving you an overview here. So $10 movement, buying at the money will give you $500. Second, you need to get this at the right moment. What is the right moment? First and foremost, we know that we buy low, sell high. Right? Everybody understands that? Buy low, sell high. Right? You buy $10, you sell it at $20. That's good. That's called buying low, sell high. Or the opposite, which is selling high and buying back low. Right, selling high, buying back low. So you're building your case now for an A plus trade, meaning that you have to get in at the lowest possible moment. Do we know what that looks like? What is the lowest possible moment? Right? If I go to the chart, what is my low? What is my high? Once you understand that, then the next thing you need to do in your game plan is to simply wait for the price to come down to what you considered low. Right? Don't just say buy low, sell high. What is low? What is high? Let the chart tell you. Right? Let the chart tell you, and you wait for the price to come to your low. That's when you get in. And once it comes down to that point, identify your other rule that said that it needs to move at least $10. Does it move $10 at least? If the answer is yes, it is an A plus trade. You can get in. So an A plus trade, to summarize, needs to be at the correct support level if you're going long on a call, or it needs to be at the correct resistance level if you're going long on a put. It needs to have the minimum expected movement, which is the difference between the current price and your target exit price. Right? And then also you need to be buying either at the money or slightly in the money. As much as you can afford in the money. My personal preference is anywhere between 50 and 70 delta. By the way, when somebody says delta 50 or delta, or 50 delta, 70 delta, or vice versa, we're actually meaning 0 point, right? 0 point whatever number it is that we said. So if I say delta 55 or 55 delta, I'm really meaning 0.55. I'm just saving a little bit of energy over there, doing my part to stay green on this planet. Do you see how I slid that in, by the way? Right? Saving words. Saving words. Okay. Who was that? Was that Erica? Erica,
Yes.
how does that sound for an A plus trade?
Yes, I understood. Thank you so much.
You're welcome. And I gave you a 40,000 foot level. There's more where that came from, but in short, that is where that is. So I'm going to do a quick plug in here for myself and say that if you want to learn how to do these and more strategies, obviously this is what I do for a living. I trade full time. I also teach, I coach, and I specialize in options trading. So options trading, this is where I make my bread and butter. You can go to optionswitheddie.com and learn all about me and everything that you will learn, and how to contact me as well. So, and by the way, thank you very, very much. I want to say thank you to everybody that is sending me these lovely messages. I love these messages. They're just, I'm overwhelmed. So thank you very much. Appreciate it. Kay wants to know what's my Cash App. My Cash App is $Eddie Gishohe. Right. That's me, right there. So thank you so much. All right. Who else has a question up there? We've got about 9 more minutes, give or take. Any questions is welcome. Any question? And also, if you like this, or you would like to consider, or you'd like to submit a topic for future presentation or a session, let me know, and I'll be happy to do that. Let me see people's faces here. I'm surprised. Do I use Venmo? Yes, I do use Venmo. So if you want my Venmo address, it is the same thing. That would be at Eddie Gishoye. Incidentally, there's a few Eddie Gishoyes, but if you Google that, that's usually me. It's usually me. Do I use Zelle? Yes, I do. I do use Zelle. And Zelle, I will have to do that because it uses my personal phone number or my personal email. So I just put that in there for you. Sandra wants to know what my next class is. That's going to be in about 2 weeks. About 2 weeks. I haven't I haven't looked at the date yet, but it's going to be roughly 2 weeks. All right. Well, thank you, Sandra. Thank you. All right. Can you show how to enter orders with risk management? Yes. Let me show you how to do that. So Erica wants to know how to do risk management. So let's show her how to do that. And again, I'm going to share my screen here. Hopefully you can see desktop number 2. Is everybody seeing my Thinkorswim? Or what are you looking at?
Yes.
Yes. All right.
Yes.
Awesome. So I'm going to go to one of my favorite examples, which is Apple. And Apple is actually in the middle of a zone here because the support is at 150. And we don't normally trade between zones. And it looks like resistance is somewhat 168. So we would be breaking our rules if we entered this trade at this particular point. Rules are made to be broken. So let's go ahead and break this rule and assume that we wanted to go in at the strike just below 163, and our target is $8. Actually, that would be a poor trade. Let's not do that. This is Facebook, and target. Nope. Again, it doesn't meet our criteria. We're looking for $10. $10 is our minimum that we want to move. 39 to 43. Nope. PayPal.
Yeah.
Which one is in the support level?
I'm gonna go right ahead. Oh yeah, I'll pull it. You know, going in.
Do that. I don't think he was speaking to us. Is this a good example here? All right, this is a good enough example here. Let's assume that, well, actually price of Airbnb is 167 and we are targeting 191. Do we have at least $10 movement?
Yes.
We do, right? 167. So we do have at least $10 movement between the current price and the target location here. So that would be 191 less 167. That's $24. Does anybody know whether I have a rule about 100% movement? Nobody knows? All right. I don't go for 100%. So Aaron is saying 70%, close enough, 60%. I go for a 60% movement, right? There's a 6 or 7%, 60 or 70% chance of likelihood. Actually, your probability of success tremendously increases if you don't go for that 100%. So I'm going to go for the 60% rule. This is an edit rule, by the way. It works for me, works for many people. And the price here movement, expected movement is from 167 to 191. I have calculated that we could potentially go $24. Is that about right? Is my math right so far? Let me do this here. I'm going to add a widget so that we can all work on this together. Looking for a calculator, and 191 minus 167 is 24. So if I target $24 in between here and there, that will be the 100% movement. But we want to capture 60%. So 60% of 24 would be as easy as multiplying 24 times 0.6, which would give us 14. We're going to round that to 14. And so 14 plus, I'm going to add 167. So we're expecting that the price should settle around 181. That is our target. That's where we think that 60% is. So that is 181. I'm rounding these numbers, by the way. And I'm going to change the color here a little bit, and I'm going to label this as 60% EM. All right, who's with me so far? All right, 40. Thanks, Kay. All right, you got it. Okay, so 167 to 181 is where we're expecting that price will start laboring, or is going to start being challenged. In fact, look at that 60% rule. I think it's dead on accurate. If I look to the left, I see a zone over here that is kind of being formed. Would you see some resistance or some consolidation at this point? So you can see that that 60% actually does make sense, right? It's an arbitrary number that we pick, but in general, 60 to 70% is where we go. So now that we have a $14 expected movement, that is what we calculated, I'm going to go to the option chain. I'm going to look for a strike that is at or below 167. Remember, we're going long on a call. Okay, and we're going to calculate what the expected target premium would be, or what the target premium would be if this stock were to rise up $14. So let's do that. Going to the trade, first things that we do is what? We always look for an expiration date that is 45 to 90 days. 20 May seems to fit the bill. It is 62 days. The second thing that we do is we look for we look for a strike that is just below the 167 or 167 itself. So 165 fits the bill. Remember, the rule here is that it has to be, the strike has to be less than the current price if you're buying a call. The strike has to be more than the current price if you're buying a put. I'm sorry, less. Did I say that wrong? Yeah, it has to be more. I said that backwards. So we're buying a call, so we're looking for something that is less than 167. 165 fits the bill. It happens to have a delta of 57. And we said that our new expected movement is 14. So the question here is to demonstrate a bracket order. Is that right? Are we still on track? That is what we're trying to do. So to do that, I will simply right click on the ask price, the one that says buy, on the 165 strike. I'm going to right click on that. I am going to push buy custom. I'm going to choose with OCO bracket. Right, with OCO bracket. And notice that I am presented now with three possible orders that I could place. The very first one, the one in green, that is my order entry. I'm proposing to buy 165 call contract expiring 20th May. I don't know why they say this one the English way, but wish they could just say May 20th. It's easier to say it, right? I think. But anyhow, $16.05 is how much I'm paying. In real money, this is $1,605. Remember the 100 multiplier, right? When we're talking about options contracts. And now it defaults, or rather Thinkorswim defaults to giving me just $100. I'm saying, no way, Jose. I think this is worth a whole lot more. Well, how much more is it? So the expected movement is $14. We know that every time Airbnb increases by $1 for this particular strike of 165, then my premium of 1605 should increase by 57 cents. So I'm going to save you some time. Every time it increases by $1, so from 1605 increases by $1, then new premium is going to be 1662. I'm going to add another 57. It's now 1719, and we could do that about 14 times, but we only have a few more minutes. So we're going to do it the easy way. The easy way is to simply do that expected movement, which is 14 times 0.57. Let's do that. 14 times. Who knew that it was going to be as hard as this to do a calculator with a mouse? 798. So our premium is going to increase by 7.98. So trick question here. Well, not really a trick question. Real question here. If we buy this at 1605 and we are expecting a profit of $7.98 in premium, how much should we sell it for?
About 24.
How did we get to 24?
16 plus 8. Rounded up.
Got it. She's absolutely correct. And since we like whole round numbers, we're going to just plug in $24. That's how we got 24. Right? What she did was 16.05 plus 7.98. I'm going to do it on the screen here for your benefit. So 7.98 plus 16.5. She got 24.03, and we rounded that down to 24, which we like, right? So we're going to make roughly about $800, give or take. That's how we call that our take profit. That's how we enter that take profit order. What's this next one? Well, this next one is our stop loss, right? Our stop loss. So this is a subjective number here, and let me see. Where's Erica? Erica, again, you're on the spot. What is your risk tolerance on this kind of a trade? We give you the numbers. You're spending $1,600. You are potentially getting $800 on this trade, which is about 50% return on investment. How much are you willing to risk? She wants to risk $200. All right. $200 is great. I'm going to go with you. Not going to ask any more questions. She wants to risk $200. What number should I put in here? If I am paying $16.05, what should this number here be?
$14.05.
I like that. So we just got a full example of a bracket order that takes advantage of the ability to enter the trade, take profit, that's best case scenario, and worst case scenario, which is really not the worst case, protects us from losing more than $200, give or take. And then I'm going to push confirm and send, and let's take a look at what happens. 3 orders in this bracket order. The very first one is to buy one of Airbnb 165 at 1605.
Eddie,
Yes.
Do you suggest changing this from day to
I would.
GTC?
I
Just
I
because.
like your plan. I always forget to do that. So thank you for reminding me,
Okay.
because this could take longer than one day.
Yes, sir.
Appreciate that. That was who was that? That was
Abba
okay. All right.
from High WT. Thank you.
Got it. Abba. I think that's easy to say. Abba. The group Abba from the 70s, right?
Yes, sir. Or Abba Father.
Yes, what he said. Cool. So yeah, I always go with the GTC. I highly recommend that you do the GTC, and that will help preserve this order. What happens if I forget and just send this? Will this even take? Will this even happen on Monday morning if I were to confirm and send? The answer is no, because a day trade or order type of day, actually time in force, that's what that TIF means. Time in force means that this order is only good for whatever that you put in here. So if you put in day, then day simply refers to between the hours of 9:30 Eastern and 4 p.m. Eastern time. And so if you're not in between those two times, this order will never happen. At 4:30 p.m. Eastern, these two orders would drop off if you had just day. And that's why you put in GTC. Well, how long can it be in GTC? Well, GTC can, this order can be resubmitted up to 90 days from original submission. 90 days, 90. That includes nights and weekends, whether you're in the US or Canada, it's 90 days. That was a joke over there. You guys are supposed to be laughing, but I don't see your faces. Yeah. All right. So confirm and send. Let's push these 3 orders in one. That's a buy to open. This is a sell to close. And then and the next one is also a sell. So this is worst case scenario. The order number 3 is the one that is protecting you from losing more than $200. I did say it was approximately $200. Why is that? It's approximately $200 because this is in fact a market order. Do you notice that it says market right here? So if the price or if the premium drops to 1405, the system triggers a market order. This is not saying that you will get out at 1405. This is just saying that at 1405, trigger a market order. When we trigger a market order to exit the trade or even to open the trade, the system arbitrarily picks whatever price is available because the intention is to get you into the trade or out of the trade. In this particular case, it is to get you out of the trade. And so it could get you out of the trade for either $14.05, $14, $15. It's an arbitrary number, but the intention is to get you in at a better price or whatever price. And then you would confirm and send. But wait, there is more. I just noticed that the meat price is $15.90. I also remember Ololade saying that, you know what, we should probably negotiate these, right? We should probably negotiate these. So I'm going to unlock this padlock. I'm also going to tell it, you know what, I really do want that $15.90. But now, here's another trick. I know that my expected profit was $7.98, so that's about $8, right? Could I push these and say that whatever price that you get me in, just simply get me $8? Could I do that? Yeah, I can do that. Could I also do the same thing and say that, you know what, I'm going to make this into a trigger and simply protect me if the premium at whatever I get it at, simply protect me at a loss of value of premium of $2, which is $200 in real money. So then you would push confirm and send. It will do the math for you at whatever you get filled. So hopefully, Erica, that is that does answer your question on that. All right, Brittany, what's up?
On your, when you did your limit, your sell limit order, you did your delta plus your expected move, I mean, times your expected movement, right?
Delta times expected movement. Yes.
Okay, so when you're doing your stop loss, you don't include the delta in there at all?
No. Nope. My stop loss is subjective. It's what my risk tolerance is.
Okay.
Right? So according to Erica, she is willing to risk $200. I know she doesn't want to lose 200, but she's willing to risk 200 and saying that if I get filled on these, believe she has done the math and said that her potential profit here is $800. So she's willing to make a risk of 200 for a potential gain of 800. And I think that is a very, very good risk. The other way that you could have done it is to simply take a 3-to-1 risk reward ratio and say that, you know what, I am potentially getting $800. I am willing to risk 30% of that or 33% of that to make it a 3-to-1. The way to get to that is to do 800 divided by 3 or 8 divided by 3 and say that she's willing to risk $260. So if she put in $2.60 here, that would effectively be a 3-to-1 risk reward ratio. She's willing to risk $260 for potentially gaining $8. So 260 times 3, give or take, should be right about just under $8. That's one way to do it. It's not a very scientific way to do it because if you're working with a stock ticker like Amazon, for instance, which has an ATR of close to 100 or even sometimes over 100, in this particular case it is 118, then a 3-to-1 obviously does not make sense at all. It does not make sense at all. If you're expecting to, say, get $1,000, then, or even 2,000, let's go with say $2,000, which is not uncommon with SPX, and you did the simple 3-to-1, so 2,000 divided by 3, that means you'd be risking about $660. That does not make sense. You don't need to lose that much money to know that you're dead wrong. Yeah. You can cap your risk at maybe $300-400. That's how you do it. So I will go with Erica's numbers here. I like them. $2. By the way, my risk tolerance is $2.50 maximum on a trade. If I'm going long on a single call or a single put, $250 is usually what I have. That was my other question. How would you do these on SPX? Okay, so I did answer that question, Erica. Is that a yes? No? Maybe? We don't know. Jamoki wants to know that if this is executed, does the bracket order count as one trade or 3 trades? This is simply one trade. This is simply one trade. So if this gets executed, remember there's 3 trades that we set up. Here's how it would be. The maximum it can be is 2 trades. It cannot be 3 trades. Let me push these and illustrate that, Jamoke. This is our buy to open. Orders numbers 2 and 3, only one of them can happen. 2 and 3 are mutually exclusive, meaning that if one happens, the other one is closed. So we either get into a best case scenario where the take profit order is executed, in which case you no longer need the stop loss, so it gets cancelled automatically, or in the opposite direction where we are losing and the stop loss triggers, in which case the sell order to take profit is no longer relevant. That is why they are mutually exclusive. How do we know that? If I just push confirm and send, and I go over to my monitor tab in Thinkorswim, notice that it's got a key on the entry, and then it's got a link, a chain link, I think, on these 2 orders. One of them is your take profit, the other one is your market order. Only one of these can take place. So Your question was, is this counted as one order or three orders? Well, we've just identified that first and foremost, we have to have the one order to enter and then another order to close it, so a maximum of two orders. If these happen on the same day, that is one day trade. If this happens on the same day, that is one day trade. If this order is filled, say on Monday, and then the profit happens on Tuesday, no penalty. You don't lose a day trade on that one. That's really good for you, right? Can this happen on such a situation? Well, let's look at the chart and see. We're expecting $14 movement, and based on what I can see, the ATR on Airbnb is what? Is 9.4. So I would have to have, or we would have to have an exceptional day for this to happen in one day. So I think this would happen over several days, because even the 9.4 ATR does not mean that we go up 9.4 on the same day. That would be a combination of an up and down movement. So this would be a good trade if our thesis says that the Airbnb is going to continue to go up. Great question on that. How do I determine the premium since it moves so fast? I don't know. We look at the option chain.
Eddie, I'm talking about like on SPX and how you just mentioned like some options there, you know, the premiums are higher, and if they move fast, how do you determine a good stop without getting stopped out quickly every time?
Okay, so you do have to learn SPX. It is one of those ticker symbols that is very special. I'm going to call it a special kid. So you have to learn it and see how it moves and get used to those price movements. And if you are trying to scalp it, then you need some different strategies in there. But if you're going the regular, going long or going short, and you're looking for the 45 to 90 days or 30 to 90 days, whatever, then you really want to be as close as possible to the support if you're going to buy a call. And that way, a few cents there will not make such a big difference.
Okay.
See where I'm going with that? So if the price of SPX, you know, for instance, is about 4,463, and the premium is roughly $20, give or take. Actually, we can tell from here. If you're going 61 days, then you're paying a lot. But do you normally do 0 DT on that? I don't want to dwell too much on this question. It's digressing, but
I have before. And yeah.
All right, so they do cost anywhere from around somewhere as $10. I've seen them as low as 10, or even on low VIX days, maybe even 5 or 6, all the way to about 60. I've seen these even go to 60 or 70 or even 100. Very, very common for SPX during times of volatility. So first and foremost, when you're buying premium for the longer term, you want low volatility, right? Low volatility, meaning that you want that IV to come down, because the minute you buy it, if the IV crashes, if this volatility reduces, even if the price does not move, that premium will decay significantly. So topic for another day, but I just wanted to give you that tip over there. What were we working on here? Airbnb. All right. So since I don't want this to trigger on Monday, because I've not thoroughly researched this, by the way, I'm simply going to right click and cancel this order, right? And notice that once I canceled that, what did it do? It canceled the other two because they're no longer applying. All right, cool. Without getting constantly stopped out, I didn't see that part of your question. You're probably having a very, very small stop loss if you're being stopped out. Hey, Brittany, you still have your hand up. You have another question, right?
No, sorry, let me put it down.
Oh, okay, cool. All right. I think we've gone far enough today. Unless, do we have any other questions that that anybody has that we can help answer? Is there anything wrong with zero DTE? No, nothing wrong with zero DTE. There are thousands of strategies that you can do zero DTE. So no, nothing wrong with that. In fact, for most people who trade SPX, which is the S&P 500, they will tend to trade 0 DTE or 1 DTE. But for everything else, I would suggest maybe you need time. How far out? 45 to 90 days. That's the standard. So, or that's my standard. All right. Very cool. Well, I hope this was helpful. And if you have questions, by all means, feel free to talk to me. You can find me on Facebook under the Options with Eddie Facebook page. You can find me on Telegram. You can find me on the website, Options with Eddie. And again, I really, really appreciate your support. So thank you very much. And let's see. There we go. And yes, I will send the link to those that registered. It may or may not be public, but you will get a copy of this recording for sure.
Oh, thank you. I was about to ask you.
Yes, you will get it.
Thank you.
All right. Have a wonderful Saturday, everybody. This is Eddie.
Thank you.
All right.
Thanks,
Thank you,
Eddie.
Eddie. Bye.
Thanks, Eddie.
Thanks, Eddie.
Thank you.
Eddie.
Thank you.
Thank you.
Thank you, Eddie. Much appreciated. Thank you so
You're the
much.
best.
Thank you.
Yes.
Thank you so much.